Hi there, welcome back to Dukascopy TV. I'm Ben Jones. On the line with me today to discuss the economy of Thailand is Sarah Fowler from Oxford Economics. So to begin with, Sarah, we've had the Thailand Trade balance released today. The figure's gone quite significantly into positive territory again. How does this impact Thailand, and are exports still struggling?
So for Q4 as a whole, Thailand ran a trade surplus of $1.5 billion. Exports were up nearly 2%, imports down more than 5%. Weak demand from China, who's Thailand's biggest export partner, is still weighing down regional trade. Chinese imports fell quite sharply in the second half of last year. But on the more positive side, demand from the US and the EU is improving, which is particularly helping the electronics and the automobile sectors in Thailand. And we do expect overall exports to improve this year in Thailand. The key impact on the trade balance this year will come from the lower oil price. The import bill will be sharply lower as a result of lower fuel prices. Fuel, including oil products, gas and coal, account for more than 20% of the import bill. So that's going to have a big boost on the trade surplus, which should help the currency be a bit more stable this year.
So if exports do continue to struggle, what impact could this have? And can Thailand get growth back on track?
We do see growth coming back on track this year. The latest tourism and investment indicators we've seen suggest that the economy is finally beginning to build stronger momentum. Tourist arrivals were up by 12% on the year in December. And the lower oil price again should really help households and businesses this year. Energy has a 10% weight in the inflation basket. So as a direct result of the lower oil price, inflation is going to be a lot lower than it would have been this year. The government is also estimated to have spent around 500 billion baht subsidising fuel for households and businesses from 2011 to 2013. So that's going to be a big boost to the public finances as well. So we expect 3.9% GDP growth this year, which is back on track. But I would say the risks do remain very high. On the investment side, the government does continue to hesitate about some key public projects that were mostly started by the previous government. So there's been a lot of delays in terms of the investment recovery. And the other aspect of that is the process of returning Thailand to democracy remains quite uncertain. And another thing is the royal succession. The king's 87, he hasn't been in the best health. There has been some uncertainty over what the royal succession will be, and his death could cause a lot of market troubles in Thailand if the markets respond badly and the royal succession gets caught up in the deep political divide.
And finally, there's an interest rate decision tomorrow. Do you expect any changes here?
So speculation has risen about a rate cut tomorrow, and at the last meeting, 2 committee members voted for a cut. But we think they'll hold rates tomorrow because we see activity picking up in recent months, on track for growth close to 4%. And on that basis, we think rates are okay as they are. But at the same time, if activity indicators do disappoint early this year, with inflation so low, the bank does have room to cut rates. So we think if the recovery does stumble early on this year, they may well cut rates.
Sarah, thank you very much for joining me today. That's all we have time for now, but make sure you keep clicking back to Dukascopy TV. Bye for now.